I was kind of hoping or expecting maybe they would look to other tools. This may actually reduce that, and we may be back to talking about interest rates as the main tool for the Fed. Retail sales and housing data in focus this week. Plus, Fed meeting minutes came out just yesterday on Wednesday, and some news that may affect the Fed ahead in addition to what we saw in the minutes. I'm Brandon Steele with Mainsail Financial Group here in Bellevue. Our goal is to leave you feeling more empowered each week and share with you some of the market news, the trends that we're watching here that are truly shaping market movements, and certainly quite a bit to cover here this week. I will actually go a little shorter on some of the data side of it because some of the news is actually something worth keeping an eye on here this week. So basically, I'll back up to last Friday just to kick us off. So last Friday, we had retail sales come out. We've talked about this quite a bit as we look at, the strength of the economy and what's going on and how markets have continued to accelerate here through the course of 2026. But one of the things that we need to continue to watch is the consumer. So we did get a glimpse into the consumer on Friday. Retail sales came out that day and basically showed that we were down 0.6%. So as always, one data point is not something to, completely upend anything, but it is an important data point to watch, and it is below expectations. And again, the consumer is really important at this moment, especially to see how some of these higher oil prices and things like that could start to carry through to consumer spending, and how we're making decisions basically as consumers and as individuals in the country. So that is very important to watch. One data point, not the end of the world by any means, but it is a factor, and it is something to keep an eye on for sure as we continue to get more retail sales, more consumer data, and all the above here as the year draws down. We also had housing data come out. This is not anything new. Housing has been in a bit of a pickle as of late, and certainly in Washington State or in Seattle in the Pacific Northwest, we're feeling it a little bit less than in other areas across the country. But nonetheless, countrywide, basically what we saw is housing starts came in at 1.2 million. This was lower than expectations. We also had pending home sales come out, which were down 2.3%. So housing still, seems to have a bit of a struggle as interest rates have remained higher, I think is a big part of that. On Wednesday, so just yesterday, we also got Fed meeting minutes that came out. They were released, and basically, short version of it is it basically reinforced some things we had already covered, but clearly the Fed is increasingly concerned about this elevated inflation scenario. We're on 6 years now of higher inflation, or 5 years or so, and clearly they are getting more and more concerned about this and actively looking to figure out ways to reduce this inflation rate that we've been seeing lately. So that would be what I kind of pulled out of the meeting minutes. Again, it's nothing new necessarily, just maybe reinforcement of some things we've covered in the past and what you've heard, from the Fed up to this point. Before we touch on the news story that may shape interest rates and the Fed and all that here moving forward, be sure to tune in next week. Next week we get a lot of data. So we have GDP, income, spending, and inflation. So when I talk about the consumer, we'll get a little bit more detail on what's going on there as we kind of are able to lift up the hood. So again, next Thursday we'll cover GDP, income, spending, and inflation. But before we break for this week, basically what I wanted to cover is a question of the week around the news that came out just yesterday around the Treasury increasing their bond buyback. So basically, Besant came out and shared that they were going to double their bond buyback rate. So basically, the Treasury is going to increase that bond buyback. Essentially, it's very similar to what you might hear from the Fed about like a QE program, for instance, right? Where they're essentially buying bonds in order to affect interest rates. So it's kind of an engineered way, in their view, to try and reduce the interest rates on bonds. And this is more specifically on the long-term side of bonds. Now, keep in mind, interest rates go up, bond prices go down, interest rates go down, bond prices go up, generally speaking. So basically what we saw is a good day in the bond market, but that's on the back of a very bad year again in the bond market. And basically we're seeing a flatter yield curve now because we were starting, basically yield curve being short-term bonds to long-term bonds, right? basically the bigger difference between those interest rates you might typically expect, because if you're loaning the government money for 30 years as opposed to 30 days, hopefully you're getting a little bit more for that risk. Well, basically what's happening is now that the Fed is, or sorry, the Treasury is talking about increasing their bond buybacks. We saw the latter part of that curve come down, so we get a flattening of the yield curve, if that helps for a little bit of a visual. So it's absolutely something to watch. Again, this is one of the Fed's tools, and actually I've talked quite a bit about this lately, that, the Fed may look towards their balance sheet as ways to address inflation and all the above. This would go the opposite way typically, and may in fact have an increased impact on inflation. So it puts the Fed in a bit of a tough spot, I think, too, because if they were exploring the idea of doing something with their balance sheet, this may take that away, or at least take away the benefits of it. And I can't imagine that they would be competing where the Treasury's buying and the Fed's selling. I guess it's possible, but this does put the Fed in a bit of a tough spot, I think. And it definitely could have taken one of their tools out of the tool bags away. So we will see what comes from this over time. But I've shared, I was kind of hoping or expecting maybe they would look to other tools. This may actually reduce that, and we may be back to talking about interest rates as the main tool for the Fed to use. So very interesting development. We'll continue to keep you posted as this shakes out through the course of the coming months and into the September Fed meeting. But it's definitely something to keep an eye on. So with that, we'll break for the week. Be sure to tune in next Thursday. Again, we've got GDP, income, spending, and inflation that we'll all cover next Thursday at 3. In the meantime, have a great upcoming weekend, and we'll see you next week.